Welcome to Optionetics. Congratulations on taking a decisive step towards controlling your financial destiny. My name is Richard Kaywood. I'm the CEO of Optionetics, and I'm here today with Tony Clementor, the Chief Operating Officer. I'd like to start with a little bit about Optionetics. The Optionetics strategies were born on the floor of the exchange, where our founders of Optionetics refined their trading skills. Since 1993, thousands of people, just like yourself, have learned from us high-profit, low-risk trading strategies. But why do you need Optionetics? You need to trade in the markets specialized knowledge. You also need to manage your risk and realize that your investments need protection. You need to be able to trade in any market, whether it be up, down, or sideways. Optionetics allows you to do that. We use 27 different strategies, an arsenal of weapons which allow you to trade in any market.
Your instructors on this video are professional traders who are also two of the top investment educators on the subject of high-profit, low-risk trading. George Fontanills, who's the co-founder of Optionetics, is a professional money manager and is also a published author of several best-selling trading books, including the Options Course Book, Trade Options Online, and the Stock Market Course Book. He's also a sought-after lecturer, as well as keynote speaker at several leading investment conferences throughout the country. George is joined today by Tom Gentile, who is the Chief Option Strategist for Optionetics. Tom's been a professional trader for over 15 years, is the co-developer of many of the Optionetics risk management techniques, and is also a published author and the contributor and a guest in places like Forbes, Barron's, and Yahoo Finance Vision, as well as many other media. You'll be seeing a lot more of these two gentlemen over the course of the next 8 videos. These videos have been broken down into different trading strategies. In addition to the 8 videos, your course also includes manuals featuring comprehensive step-by-step instruction, easy-to-follow calculations, and exercises. For those of you choosing to attend one or more of our seminars, these materials will help you to get the most from our live trading demonstrations, where we use our strategies on real stocks in real time. These tapes are meant to be your at-home resource. Review them as often as you like. From time to time, the instructors are going to ask you to pause the tape and complete an exercise. Doing those exercises will help you to gain a faster understanding of the strategies. We've arranged the tapes by strategy so that you can find the information you need quickly.
But it doesn't stop with just the course materials. We want to ensure your long-term trading success, and we do that in a number of ways. All of the Optionetics instructors are professional traders, meaning that they use these strategies every day. They have an intimate understanding of the markets and the wide variety of conditions you will face as a trader. One of the features that makes Optionetics effective is our free lifetime reattendance. We understand that the markets change, strategies change, new securities are introduced, and that some people enjoy a refresher. We allow you to reattend future seminars at no additional cost. We've been doing this since 1993 to keep you on the cutting edge. We also furnish you with a free trading coach. Your coach will help ensure that you understand to construct and apply the strategies we've taught you. Now, we are not providing you with individual investment advice, and I must tell you that trading involves risk, and that you should consult with your individual investment advisor before trading. Your results will vary. If you would like to attend or re-attend one of our live seminars, please call our office at 1-888-366-8264.
Also, to assist you in your trading education, we provide a wide range of trading educational information and tools for you, free, on our website, which can be found at www.optionetics.com. The site features daily trading ideas and research from our traders, stock and options portfolios to assist you in your paper trading, news and editorials, technical support discussion boards, as well as our upcoming seminar schedule, so that you can see when we're coming to a city near you.
Again, on behalf of all of us at Optionetics, congratulations on taking action. Enjoy the tapes, beginning with Option Basics, featuring our partners, George Fontanills and Tom Gentile. Thank you.
Hi, welcome to the Optionetics video course. I'm here with Tom Gentile.
Hey, George. Good to see you again.
Hey, Tom. Hey, so why are we here today?
Well, we're here to teach the students how to make some money in this game of options trading.
Okay.
And hopefully avoid the pitfalls that I myself did early on in my trading career.
Tell us a little bit about your background.
Well, I started about 15 years ago, and I did the same thing a lot of the students are doing right now. I got involved through a course that was a video manual course. Unfortunately, it was more geared toward the general markets, and I didn't have enough specialized knowledge. And I think that to be a good options trader, you really got to have you might be a jack of all trades, but you need to be a master of this particular industry, which is options trading, and how to create strategies that lower and limit your risk.
So you learned through the school of hard knocks, that is.
I did.
Me too.
6 months, all it took for me to wipe out my first account.
Yeah, I probably wiped mine out 3 times, but that's because I didn't know what I was doing.
Yeah.
Okay. Well, anyways, we're here to show you options basics. First, I want to congratulate you. We think this is the best course around. We've been doing this for many years. How many years have we been teaching now?
I would say 7, 8 years now.
Yeah, we've had thousands of students come through, and it's pretty amazing, I think, the number of people become successful.
Yeah.
Exactly. So what do you think, Tom, is the best way for people to get started in trading?
Well, I think this video course that you're now watching is the best step. It's the first step you should do.
Okay.
Next thing, after you've reviewed the videos, come and see us at one of the live seminars, because that will really allow you to focus and put what you've learned into action, and see how we put what we've learned into action as well.
Okay. Well, basically, you're going to see 8 tapes here. The first tape is really options basics. We want you to get up and running here, and that's what I'm going to be doing with Tom today, teaching you how to start everything. Tape 2 is called Introduction to Spreads and Debit Spreads. You're going to basically learn how to do what we call spread trades, which we think are very successful. Tom's an expert at those. Tape number 3 is what we call credit spreads. That's another type of spread, which is an excellent way to trade. Tape number 4, ratio back spreads, one of my favorite things to do. Tape number 5 is trading delta neutral. Tell them a little bit about what that is, Tom.
Well, delta neutral is basically a concept where what we're doing is taking the position. It's also called a hedge ratio. It's how long or short you are with a particular strategy as opposed to a stock trader. So say a stock trader's trading 100 shares of stock, okay? Now, that stock is going to move 1 for 1. Meaning that if you buy IBM and it goes up $1, you make $1.
Right.
All right. But if it goes down $1, you lose $1 too. And what we want to do is try to put together strategies that if the market goes up, in our favor, we're making money. But as it goes against us, then our losses are much, much less than that of a stock trader.
Sounds pretty complicated, is it?
It's actually not.
Okay.
It doesn't require much more than a little bit of math in terms of addition, subtraction.
So nobody out there should be scared of quote, delta neutral trading.
I don't think so. I think people that don't know a particular subject are always fearful of it. But once they understand it, that fear goes away.
Okay. Do we have to make money whether markets go up or down? No. We can use sideways markets, which is tape number 6. We're going to teach you how to trade different strategies in sideways markets. Okay. 7, we're going to get a little more advanced for you, and we're going to take you to what we think are some of the best trades around, called advanced strategies and the 5-minute success formula. And we're also going to do collars and synthetic calls and puts. And tape number 8 is technical analysis. Why do we trade? Primarily because of the stock market makes the most amount of money. If you take a look at what's happening in the market over the last few years, basically it's been going up. Yes, you have those periods where the market breaks down again. But you know what? People make money during these periods too, don't they, Tom?
Yeah, and the other thing too is that I know that people know you're a graduate of Harvard. Okay,
no,
I'm a Rhodes Scholar, and I'm a Rhodes Scholar, R-O-A-D, meaning I learned this stuff right from scratch. And so, the other thing that George says a lot, and I totally agree, is that the market is the biggest equalizer of all people who are involved in it.
Sure. So the markets are the greatest equalizer of education, which means, do you have to have a Harvard MBA to be good at this?
No. In fact, I think the smarter you are, unfortunately, the more you think you're right and the market's wrong, and that could hurt.
Yeah, we make that joke all the time, that if you think too much, you're probably doing too much here. Basically, the stock market has gone up tremendously. Yes, there are periods where it goes down, like I'm showing you here, but eventually, they do go up again. There are certain factors that are going to create an up and down market, and we're going to go into those. Let me introduce you very quickly to what we're going to be trying to do here. First of all, we're going to try to teach you how to make money in uptrending markets, which is here. You can also make money in downtrending markets, which would be here. But you know what? Sometimes markets do go sideways, don't they, Tom?
Exactly, and we've seen a lot of that lately.
And it's exactly it. And what we're going to do is try to show you that given that markets go up, down, and sideways, there are strategies that can work in all of those.
That's right.
And you just got to know how to first manage risk. Isn't that correct?
That's the biggest thing, is managing your risk. And then also, you know, I think the number one thing is to be able to really get a good look at a chart and understand how to read it, and then to take action with one of the limited risk trades that we're going to show you.
So the biggest sins that a trader would make is what? No trading plan.
Oh, yeah.
Number two, no system in place. And last but not least, we've done this a long time, risk management. If they have atrocious risk management, they're going to lose their money.
And I've suffered through all three of those.
Okay.
I think you know, I've said this before, and I'll say it to the folks that are watching the video. My no trading plan. This was the day that I wound up losing my whole account, which really got me to thinking just how ineffective I was in terms of money management and risk management. Was, you know, I just listened to the guy on CNBC that had the loudest mouth the day I was trading, and that doesn't obviously mean he's going to be on the right side. You know, taking that, dumping all my money into one trade, and having no exit plan. You know, it's no wonder I didn't lose my money sooner.
Sure. So basically, the mistakes we're looking at that a lot of people who are watching this video are: one, they think that trading stock is the right thing. They think it's a cheap way to trade the market. I think it's the most expensive thing to do.
I do too.
In fact, let me take a minute to show you what I mean about that. What people don't realize is that when you're playing a stock, let's say you've got a stock, 1,000 shares of a stock that's at $20, you have to put up $20,000. However, there's something called margin. Margin is the amount of money that you have to put up in a trade. The SEC allows you to put up only half, so you have to put up $10,000. Well, we look at options as a way to, one, lower your cost, because you're going to have leverage, but also you're going to be able to lower your risk. What people don't realize is it is actually riskier to trade stocks than it is to trade options if you have knowledge. Is that correct?
That's right. In fact, you know, like we said before, sectors and markets will go up and down. There seems to be periods in time where every 10 years or so, this big hot sector comes around and goes screaming upward and then right back down. It's like a roller coaster. And you got to be, you know, if you're on the stock, if you're playing the stock, it can be very expensive in terms of not only cost but risk.
Yeah. Also, the analysts' upgrades and downgrades. You know, do they really know what they're doing most of the time?
Well, you know, rather than really get into to that big, you know, real big today, I think what people really need to realize is that you are your best analyst, and that means that, you know, what we're going to teach you in these 8 tapes. You know, George and I have learned this through the School of Hard Knocks, and that you know, we're going to be able to save you thousands of dollars just by not making some of the mistakes that novice traders make, including ourselves when we first started trading.
And then CNBC, we all watch it, but you know, we call it entertainment for adults.
That's right.
You know, if you're going to listen to them, you know, you're in trouble in most cases.
Yeah, and they got a lot of good information.
You know, they've got great information, but you know, you can't go on every tip that someone gives you there.
Exactly, and people got to realize the big reason that CNBC exists is to fill time. I mean, they're no different than the Fox Sports Channel. They're there to you know, obviously turn a profit in what they do.
And the last mistake is a hot tip. Well, it's usually the hot tip of a knife, really. You know, so you don't want to listen to other people when they say, "Oh, I got a great tip for you," right?
I've made that mistake.
That means
too.
they're probably trying to get out of their positions because you're going to buy it.
That's usually the case.
Okay. So what we're going to try to do is find high profit, low risk trades in optionetics. We're going to look for strategies in any market, like I just showed you. Minimize risk, most important thing, maximize reward, and protect your assets. That's the most important thing. In fact, what you need to look at is, you know, when you've got, you know, when you have a car these days, don't you have to protect it?
That's right.
You protect it with insurance. Well, we're going to try to find a way for you to use leverage in the best way possible. Let's talk about the major exchanges. First one's the New York Stock Exchange. Tell them a little bit about the NYSE. What kind of stocks trade at the NYSE?
Well, NYSE, you know, when I first looked at the NYSE, I realized that, first of all, the letter symbol, the symbols, the number of symbols that actually go with a stock are usually going to be 1, 2, or 3, no more than 3-letter symbols. Which also means that these are more of the big board type.
They're the bigger
big volume, big market cap. They've been around for a while.
Okay. How about the American Stock Exchange, the Amex?
It's kind of a spin-off of the NYSE.
Sure.
They also cover big name stocks, but just not as many. They're just a smaller, a little bit smaller exchange. They've also created a lot of really neat, I think, index options to trade like stocks.
But the NASDAQ, the National Association of Securities Dealers Automated Quotations.
That's a lot. That's a mouthful. I just think NASDAQ is good enough for me. You'll never hear that.
We refer to it as that. You know, honestly, that's the first time I've ever said that in my life. You know, luckily it's on a screen. Otherwise, I wouldn't be able to know it. Okay, and then how about the Chicago Board Options Exchange?
Well, yeah, the CBOE is actually a total exchange. You know, exchange that actually trades options. Sure. And these all kind of spun off from the NYSE.
Aren't there other exchanges other than the CBOE that trade options?
There's little regional exchanges such as
the Amex. Well, the Amex trades options.
Philadelphia.
I got to get my pen. Okay.
You get your pen.
Okay.
Philadelphia.
Let me get my pen.
Also, the PECOS, the Pacific Stock Exchange. They've got one in Chicago.
Okay.
They've got one in Boston as well. And you know, there's other cities that are looking to do this. However, I think with online trading coming the way it is, there's a change.
Well, they have the ISE now, which is also a computerized options exchange.
Right.
You know, it's pretty amazing how the computers are taking over, it looks like, right?
Yeah. Yep, it sure is.
Let's talk about indices, which we call an index. The Dow Jones Industrial is the primary index out there that people used to look at as what was happening in the U.S. But then there's the S&P 500, which is the SPX in many quotation systems, and then the NASDAQ Composite. Which one do you look at, Tom?
Well, I look at the Dow mostly because I trade more boring stocks, as people will find out when they watch the latter part, the other parts of the tapes.
So the NASDAQ stocks, you think, are the ones that are more volatile?
They're much more volatile. Although you know, they have times where they crank up and get volatile, and then sometimes they run right down and they trade into a sideways mode, which is great for those of you that want to shift maybe toward a non-directional type of trading strategy.
So there are periods of times where the NASDAQ stocks are hot and the others are not, and then vice versa. Is that correct?
Absolutely.
But eventually they seem to come back. You know, the markets shoot up, and then eventually they somehow converge back to where they were.
That's right.
You know, over the years you've seen markets, you know, having traded for so many years now, you think you've seen it all, but then sooner or later you get surprised by the market. The market's amazing, isn't it?
I remember when the NASDAQ was just a couple of hundred points.
Yeah.
I mean, it traded a couple of hundred points, and I used to listen to the averages on the radio.
Right.
Even growing up as a kid, I used to listen to them, but all we would hear was the Dow, the Dow, the Dow. Right. Then the S&P came along. Okay. And now the NASDAQ, it seems that more people are right now looking at the NASDAQ than they are the Dow because of all the technology-based companies that are really driving our economy.
Sure, but it does switch depending on where people think they're going to make the most money.
Exactly. Okay. Yeah, rotation in this sector happens all the time.
Why would we even do stocks versus real estate or any of the other assets that people can do?
Well, you know more about real estate than I do. I do know this, though. If I put a house up on the market, I can't get out of it right away. I mean, the liquidity factor is probably the #1 reason why I like the stock market in terms of investments over real estate. I think
that's why people play securities more than the real estate. As you know, if you're going to buy or sell houses or properties, it could take a long time. So what we said, let's make our money in securities because of what's called liquidity. But on top of that, if you know what you're doing with options, you also get much better leverage. Correct?
That's right.
Okay.
Yeah.
Let's go over some of the common trading terms.
Okay.
Okay.
This is for those of you at home that have never seen this before. This is what George and I want to do is kind of cover with you real quickly what some of these terminology means. Like for example, if you own an option, okay, you're said to be long, and that means you've bought an option. You're actually long that option. If you sell an option. You know, when you sell an option, you are actually short the market.
Right.
And that short doesn't mean in terms of size, okay? It means, I might be a little shorter than you, but that doesn't mean I'm shorter along the market. It means I've actually opened a selling position up, and to close it, I got to buy that back. So when you enter a trade, that means that you're opening a trade, whether it's a long or a short. If I wanted to sell an option to open, that's what I'm doing is I'm opening the trade. Right now, to close the trade, basically what I'm doing is exiting. When I exit a trade, I am closing the trade. Okay. When you pay for your trade in full, all right, what does that mean? That means that you're actually using a cash account to pay for your trade in full. All right. When you are using purchasing power, leveraging, all right, this is called said to be using margin, and you need a margin account to actually perform that. Okay. Now, what about converting an option over from say selling it from?
Well, let me go at just a second. So There's two types of account, a cash account and a margin account. Most people have a margin account because they're able to get more leverage.
That's right.
Yeah.
Well, I think also it depends on the trader. Someone who's just trading stock more than likely will only have a cash account.
Okay.
But if they are into more of a trader who trades more often, or they're in the options markets, they probably have a margin account.
So we should, if they're going to open accounts, they should do both, right?
I
give
believe
them the
so.
access to both of the accounts.
believe
Okay,
so.
that sounds good. Okay, well, let's talk a little bit about exercise. You were getting into that?
So if you actually convert an option over into stock, and one contract would be converted over to 100 shares of stock, that actually means we are exercising the option.
So one option, which we'll go into later, controls 100 shares of something. So
Right.
I can do an option on a house, your house. I can do an option on a car. What we're going to do is option on an asset, this asset being stock, which we're going to spend this time discussing. Okay?
Exactly. And then the last thing I want to talk about is, what is the buyer willing to pay?
Okay.
Okay. What, you've got basically two things. One's called a bid and an offer.
Okay.
And bids and offers are on everything,
Right,
not just
exactly.
stock. They're on everything. And if I were to throw my attention to one area that everybody knows about is eBay.
Sure.
Okay. On eBay, they have bids and offers as well on cars, on jewelry, on practically everything. In the markets, when you pay for something, the buyer is actually on the bid. The seller is actually the offer price.
Sure.
And we as traders, I can't pay the bid. I mean, if I can't come in and pay a bid unless you're willing to lower your offer.
Sure.
Usually I'm going to pay your offer,
Okay.
or I'm going to sell at a bid price.
Sure. Well, I use the analogy of a car dealer. There's a bid and an offer, right?
That's right.
Basically, you put a bid in. Well, basically, my car is, you wanted 1,000 less than their offer, and eventually you come to a trade, and that's when a trade is made.
That's right.
There's two parties to every transaction. Therefore, they have to agree on the price. Let's talk a little bit about the types of orders. The first one is called the market order. It's an execution guaranteed at the current market rates. For example, if I want to get into something right now, it's a market order. Let's use the analogy of the car. I want that car no matter what the price is, then that's a market order. Not a good idea, by the way.
No, I call it a burner order.
Yeah, I mean, it's honestly...
It's the buy it now option on eBay.
It's like,
if you buy it now, you're paying the absolute highest price you're going to pay.
Right. It's basically, you're starving for food and you enter McDonald's and you say you'll pay a higher price than everybody else. That's a
Just
market
to get
order.
to the front of the line.
Yeah,
exactly.
So we don't suggest those, as you can tell. I hope you figured that out by now. Okay. A limit order is where you tell them what price you want, which is what we normally do. We
I
say,
use them all the time.
Yeah, I mean, the limit order when you're putting an offer on a car is, I want this price, and that's all I want to pay, and then they can come back and negotiate.
That's right.
So that's primarily in the types of trades we do. I think the only market orders I ever do is if you're really in a big position, or if you're in a position you really think you've got a lot of profits and you don't want it to get away, maybe I'll give up a little bit, but limit orders are best, correct?
Right, and I use more limit orders to open positions than I do to close.
Okay.
Sometimes if I need to get out of something right away,
Okay.
I may go to a market order, or I may usually what I'll try to do is I'll look at where the market is and I'll place a limit order at that offer price, just because, unfortunately, market orders, you see one thing on the screen,
Okay.
and you can get something entirely different when it comes back to a fill. Example, if I were to buy Microsoft at 100, if Microsoft's moving up pretty quick, I might get a fill at 101. And I mean, that difference between what I thought I was going to get and what I actually wound up with is what I call slippage.
Sure.
It's one form of slippage.
Exactly. And then there's also the stop order. For example, when people buy stocks, their brokers may say, well, you buy the stock at 50, let's go ahead and put a stop order at 45. Which means if it breaks, the stock goes from, in fact, better to draw it off here. Okay. If the stock, let's say, is a $50 stock, you then put a stop here and you buy the stock at 50. Okay. You might say you put a sell stop down below it, meaning that if the stock breaks the 45, you want whatever price there is. The problem with that is, stocks have a tendency on bad news. If it's going to get to 45 overnight, it actually may be 38, and you're going to get the $38. This price is irrelevant, where in options, you actually build that sell stop in.
That's right, yeah, and that's why I like options so much. The other thing, too, that I wanted to point out, George, and I know you already know this, but I don't think our video viewers at home know this, and that is that you can actually put stops now on your option trades.
Right.
If a stock actually hits a particular stop price, your option trade can automatically get executed. That's called a contingency order. Right. And what you want to do is check with the broker that you use to see if they offer contingency orders.
That's an interesting. Yeah, a lot of brokers before never wanted to do that, but now they're willing to do that.
Yeah.
That's good. That's a good change. So one of the things on the stop order, I think that's one of the biggest misconceptions in trading stock, that this will save you.
Oh yeah, yeah. I mean, I can think of we were doing a live seminar, and I remember, was it MicroStrategy?
Oh,
it was MicroStrategy was at 100 one day, and it was at 50 the next. And George and I are looking at this thing, and we're thinking, it must have split 2 for 1.
Must be a stock
That's what we thought. It wasn't a stock split. It was a stock split, but it only came in as a 1-for-1 stock split when it opened down 50% lower.
Which is part of our video here. We want to show people how to pick, hopefully, good stocks to do the trades in. So.
That's right. But also create these limited risk trades where if the stock opens up 50 points down on you, you might lose 2 or 3 or maybe 5 instead of 50.
And then we have the good till cancel order. The good till cancel order means that you want it in effect until it gets executed. I have a problem sometimes with good till cancels because brokers really hate these things.
Yeah.
They like to put them in their pocket and they forget about them. I call them good till remember order.
That's exactly what I call them. And what I'm worried about with those is that, let's say you play, it's not as bad on the entry. It's real bad on the exit. If you put it in, you don't get filled, and then you say, oh, let me just do it at a limit or a market. You get filled, you forget to cancel the order.
Right.
Then a week later, you get a call from the broker telling them that they filled you on an order. Now all of a sudden you're not only out as you were the week before, you're back in again.
Right. So to summarize what we just went through, limit orders are the way you want to trade.
Exactly. Of everything we've discussed, limit orders are the best.
Okay, so when we place the types of trades we're going to do, you're going to see that we structure buys and sells, and we say this is our price, and we try to be cheap about it. I mean, we try to go to Walmart or whatever when we're putting orders. We don't want to give other people their money. We want to try to keep as much as we can ourselves. Okay, so most of you or some of you out there probably don't even know how a trade is really created. Basically what it is you got a lot of players involved. You got yourself, you got the floor traders, you got your brokers, etc. Really what happens is, you're going to call your broker's either going to put the order in an options order. If it's fewer than a certain number of contracts, it goes through a computer. Otherwise, it's going to go to a specialist desk. And the specialist could be Tom. Tom sits there. He's got an order book there. And he tells the traders who are market makers what the buyers and sellers want to do for those options. Eventually, you're going to get executed. What happens in that case? Okay, I put the order in. Now they've got the order back. What do?
Well, once they get the order back, actually the process just basically reverses itself.
Correct.
That's about all you really have to know is that when you put your order in, it's going to go through these various steps that you see on the screen. Once the order's filled, the steps then backtrack themselves.
Okay.
And what you see basically at the bottom is just an idea of where you got filled at, especially even online. And some online trades, I want to make this important. This is an important point. Online trading, when you trade online, sometimes it doesn't actually mean that it gets zapped to the floor and right back. A lot of online trading goes just from your terminal to the broker's terminal at his desk. He then gets a print off, pulls that thing off, and then it goes through its regular path to the floor. So what you see as online trading may not be online trading. It depends on what type of broker you are using.
Right, okay. So really there's professional traders, short-term traders, and then the individual traders, which are most of our viewers.
That's right. And the individual traders, what's amazing, and you and I both know this, you make a mention at every seminar that you bought the first 486 computer, one of the first ones, and paid big money for it.
Exactly.
And what is really neat, and what's happened is technology's gone up. These computers are just amazing. I mean, I'm running dual Pentiums myself, yet the price has gone significantly down. So guess what? Now that individual trader has the tools that the professional trader used years and years ago.
Exactly right. So, and the tools are less and less expensive, which is what we're trying to do. Well, let's talk about some of the rules of the game. One, what is the psychology of trading? First and foremost, the market will always be right. You may think it's wrong, but you know, and we all do when we
as
first
much
start
as we try to not use that rule, it usually teaches us a lesson.
If the market goes up, there's a reason. If it goes down, there's a reason. The next thing is knowledge. You got to build your knowledge base, which is why you're watching us here. You're going to basically be here and try to learn as much as you can about options and raise your learning curve very quickly. Trading capital, only trade with what you can afford to lose.
That's right. That's a big one, because what it's going to do is it's going to allow you to be able to put money out and create investments and not have to worry so much about where they're going. And I think a person who is more focused on their trade and less on their money is going to be a winner in the long run.
And then you want to manage your risk, obviously. Risk management, very, very important. And market strategies, last but not least, and certainly not least, is learn to apply the correct strategies to whatever the market conditions are telling you. Kind of like what we talked a little while ago.
That's right.
Okay, let's talk about the basics of options. This is the very beginning of learning how to trade options. Read chapter 1 through 7 in our manual. That would certainly help you out. Let's talk about an option. Basically, an option is just a right, but not an obligation to do something if you're buying options. The seller of an option has other rights and obligations, and we're going to get into that. There's two types of options, calls and puts. And let's start...
Yeah, I threw this up here, George. So what I did was I thought this was really one of the easiest ways to understand what an option was. I found this on eBay. It was the right to buy a BMW. Okay. I guess what happened was the guy had his place in line, and then he just couldn't come up with the funds. So rather than let it go and let the dealer decide who's going to have it next, he decided that I'm going to sell my place in line. Okay. So he sold his, he's trying to sell his place in line, as you see here, and he's got a bid and he's got an offer up there, and if you want it now, you can pay $3,000, but the bid is $1,000. And I really don't know what wound up happening on this, but this is a really good example of what an option is.
Sure. I've done that. Actually, I have an option on a car too, coming on the year 2003, a new Dodge Viper. I put my option price in.
Somehow, I'm not surprised.
Not surprised, So, anyways, I did the same thing. I put an option on it for till the year 2003 at a certain price, which I like options, obviously.
Come to think about it, I think I was an options trader when I was a teenager, because I used to sit outside the Ticketmaster, me and a couple of friends, and we'd be the first people in line. And we had realized that we can't scalp tickets. That was illegal. So what we wound up doing was selling our places in line. So we were actually selling options on concert tickets.
Right.
Just didn't know I was an options trader that early on.
So really, in summary, the option is a way to control something for less money.
Exactly.
Okay.
Yeah.
Or when you get engaged, that's an option on being married, right?
I'm not touching that. I'm not going there.
At least you want to be videotaped on that.
Not going there.
Okay, anyways, let's talk about call options first. Remember, in a call option, it's a contract to buy at a specified price and at a certain time. Now, let me just kind of show you what a call really is in a little more detail, because there are two parties to a call option. Just like there's two parties to eBay, so to speak.
That's right.
Let's go through calls right here on the screen. You're going to have a buyer, okay, and you're going to have a seller. For the viewer, why don't you go ahead and put yourself in the buyer's category, okay? This is you, and this will be myself and Tom. We're the sellers of this option. Now, remember, what you're trying to do is control an asset for less money. So what you are doing is you are going to buy a right to purchase stock at an agreed to time at agreed to price. We're going to do this slowly because I know some of you don't know what this stuff is. So you're the buyer of the option. You're basically going to buy this right from who? From Tom and myself. We'll be your sellers. So we're going to sell this option to you. Okay. Now, however, you're going to have to pay us for this. Okay. Because we're not going to give you an option for nothing, right?
I wouldn't.
Okay. Anyway, so you're going to pay us something called a premium. That is the amount that we are willing to sell this option for. Now, for this obligation, which we are now taking, you remember, if you've got a right, we are creating an obligation over here for us to do the opposite, to sell the stock at that agreed to price and agreed to time. So in essence, an option is two parties, a buyer and a seller. The buyer of a call option is going to have a right to buy the stock. The seller has the opposite, which is the obligation to sell the stock at that price. Okay?
This looks like insurance to me, home insurance.
That's exactly right.
It's the best way to explain it. Is that what we're talking about here, guys? Is you, the buyer, could be buying home insurance, and we could be State Farm, selling you the insurance.
Right.
And the other thing that is probably good to bring up now is when we talk about premium, and I know we're going to cover this later. Is some stocks have higher premium on their options than others, and it's kind of like insurance. If I'm living in Texas and I'm purchasing hurricane insurance, and I'm living up on the north side of Texas, it's going to be cheaper than purchasing hurricane insurance down in, say, the Brownsville area of Texas, right on the Gulf of Mexico, because obviously the chances of bad weather are going to be much more severe when you're living on the beach than when you're living inland.
Well, it's kind of interesting. I mean, there was a storm recently. I'm looking at this house on the Gulf of Mexico. This is real. Just a few days ago, storm in the Gulf. They said before you close, get insurance. Nobody wanted to sell you insurance. So, same thing. If something is too volatile or too risky, the price is going to go up tremendous.
That's right.
Right? Because you and I are taking the risk. If we're the seller of the option and you want us to sell you that stock, if it's going to move a lot, we're going to say to ourselves, hey, we want more money for this thing, right?
That's right.
Okay. So basically, once again, if you're going to buy an option, you're going to have rights. The seller has obligations. This is a riskier part to be in. The seller has more risk in most cases, unless he hedges his risk, because he's got obligations. We like rights. Rights are good things in most cases. So we're going to show you how to cover your options. Okay, let's go into what a put option is. A put option is, in fact, it's very similar, except it's the opposite. You're going to have a right to sell at a specified price in a certain time. Once again, you're going to have a buyer. You're going to have a seller of a put. Okay, two parties always. The buyer is going to have a right to sell a stock at agreed to price and agreed to time. Okay? So what you got to look at is what the seller. We're the sellers of the option. You are the buyer. You have a right to sell it. So if we sold it, we are going to have, remember the big word, the obligation to buy the stock.
And a good example here, folks, would be Qualcomm. Now, I think about when Qualcomm was at $800 a share before the split. Wouldn't it be nice if you could have sold Qualcomm right up around the $800 or actually after split $200 price range?
Right.
This would allow you to do it. Buying a put option will allow you to sell that specific stock at a specific price in a certain amount of time.
Sure. And one thing we do in our class, I think we really drum this in. Who has the rights, who has the obligations? You got to go backwards and forwards on that. Okay, on your screens you really see what are the things you can do. In a bullish market, you can buy an asset. What's an asset? The stock. You buy calls or sell puts. Okay, so there are three things to do in bullish markets: buy assets, buy calls, sell puts. Bearish, you can sell the asset, like sell the stock, buy puts, or sell calls. We're going to get a little more into that as we go. Okay. Let's talk about the elements of an option. First, there's two types of options, a call or a put. What is the strike price? The strike price is a fixed price at which you guys are determining what price you want to buy or sell something at, correct? Or where the rights and the obligations are going to be created. Next, there's an expiration date, the date at which the option may be exercised. Okay, we'll talk a little bit about that as we go. Next is the option premium. How much is someone willing to buy or sell that option for? Remember, typically, if you're a buyer, there's got to be a seller, and it may be another individual, or it may be what's called a market maker, a guy on a floor trader. Okay? And last but not least, what the underlying stock will do. For example, IBM or whatever. If you're buying or selling IBM options, as it moves up or down, that's going to determine how the option moves.
Yeah, I want to just touch on the first three, which is the call and put, the option type, the strike price, and the expiration date. When I first started trading options, I thought, well, gosh, there's only two things to do: calls or puts.
Right.
Okay, just two. But then you start looking at strikes and you realize, okay, well, we've got strikes prices there, so there's not just two, there's many more. Right. And then expiration dates actually cube it out, so there's many different variety of strategies and strikes that you can actually take.
So in this example we have in front of them, basically a strike price, they could have a lot of strike prices depending on what the traders think is going to happen to that stock, or if it's been at many, many different prices. For example, we have IBM on your screen. We have IBM at 105. Let's look at, you got strike prices, say the 100, 105, 110s. But those can go up way even further than that.
Yeah,
right?
the example, you can actually have strike prices can also come on index options as well. You know, when I traded primarily the OEX options, I remember looking at 500 symbols because that's how much my data feed would. My data feed would only limit me to 500 symbols, and when I looked at the calls and puts, the amount of strike prices on this thing, I would just put the one symbol in OEX, run all the options, and I'd run out of symbol. I mean, I'd hit my symbol limitation. That's how many symbols were in this one instrument.
So the strike prices, the way they trade is strike prices, each stock has $5 increments unless it's under $25. Then they have $2.50 too. So and then, you know, so they kind of determine how they create them based on where the stock's going to be or where they think that it can actually trade. Expiration dates. This is one of those things, for example, we have IBM, the 105 options, January, March, you know, it could be May, it could be January of the following year, it could be January of the following year, and those are called leap options, the longer term options.
That's right. And you know, also, too, is that if you're just getting into understanding about what expiration is, you know, the biggest thing to realize is that we buy car insurance.
Right.
Okay, we all buy car insurance if you drive a car, hopefully. And when you buy insurance, you actually have different lengths of premiums that you can take.
Right.
I know Geico, as an example, has a one-year premium. Okay, the company that I deal with has 6-month premiums.
Sure.
And the one-year premium is going to be more expensive than the 6-month premium.
Sure. So in essence, what happens is the traders determine these prices based on a number of different factors. And what they're going to do is the longer this expiration date, the higher the premium because of something called time value.
Basically,
we'll talk about
right.
that in just a little bit. What we don't want the people to do is get scared of all these option strikes, do we?
No, not at all.
You know, there's so many option strikes, expiration periods. You know, I think when I first started trading, just like you look at all this and you're like, who can ever figure this stuff out? You know, there's just too many of them, and you know, we want to tell everybody, certainly who's watching this, that you can certainly be very creative, but certainly don't be scared about this stuff because there's certain rules you follow and you make it work.
One of ours is real simple. We stick with where the volume is. You stick where the traders at, and you know, mostly the near money options are really well. But the one thing about expiration that everybody needs to know is when does an option expire?
Sure. Exactly.
You know, and on the screen here you can see we've got an expiration date. Basically, options expire. They actually expire on the third Saturday of each month.
Correct.
But we put third Friday up here because that's the date in which that's the last day you can trade them is the third Friday, unless you have a broker that works on weekends.
Now we're talking about stock options here. Not all indices actually close on that date. They got to be careful sometimes.
That's right.
So,
that's right.
You know, so they got to if they have a question as to when the expiration is, they should ask who? The broker.
That's right.
Okay. Next thing is options premium. This is what the buyer and the seller pay for, or the seller receives and the buyer pays when they're doing options. And as we were talking about, the longer you go, they're going to get more expensive for various reasons. You know, we're looking at IBM here. For example, January, March, and May, we have the 100 options at 6 3/8. They get a little more expensive for a few months later, and then they get more expensive again. Okay, and they're then depending on where they are, and here you have in your screen whether they're in the money, at the money, or out of the money options will also determine whether or not what the price is.
Yeah, let me make one more point about the options prices with expiration dates. You know, if you look at the January, which is 6 3/8, you know, and then March gets a little bit more expensive and May gets a little more expensive. The one thing that we need to actually make sure that that you at home understand is that options prices, when you get premium, the premiums, you know, say January could have 60 days to expiration, and then March could have another 60 days, and May could have another 60 days. But realize that if you actually divide out May, it looks cheaper. It's actually cheaper per month to go out and buy May because you're buying time in bulk instead of you know, piecing it together.
Yeah, but what we usually find is that people make errors trading options primarily because they don't know which ones to buy or sell, or they buy or sell the wrong one. So we hope to keep them away from those errors that people typically make. On your screen, you have what we call, you know, where it is relative, where the option is relative to the stock price. Is it in the money, out of the money, or at the money? Here we have the stock trading at 100. You have the 100 calls and the 100 puts being right at the money, which is where the stock is. Now, on the call side, you have to determine where your rights are. You know, in the example we have here, if you buy the 80 calls, you have a right to buy the stock at 80. So that gives you the right to buy it at 80, but it's already at 100, so you have what we call real value. Okay, so if you have a right to buy something at $80, sell it for $100, there's $20 of real value there. So those are called the in-the-money options. If you have a right to buy something at 120, which is the calls, and they're trading at 100, well, you don't have rights yet because you only have a right at 120 and it's only at 100. Those are called out-of-the-money options.
And notice, too, that these are actually color-coded for you on the screen. In this example only, green means that we have some green. We have some real money. We have something real there, okay? Yellow means, we're at the money. We could be in the money soon. We could be out of the money soon. Okay. And then the red actually dictates that we have out-of-the-money options. The other thing, too, is to look on the right-hand side, and you'll see that it's completely reversed. So if the stock's trading at 100, the 120 puts are in the money. The 100 puts, which are at the money, are the same as the 100 calls. I mean, we're right at the strike price. The stock price is at the strike price. And then if you go down, the 80 puts actually become out of the money on the put side.
Well, that's because, once again, because on the puts, you have a right to sell something at 120. So if you have a right to sell it at 120, but it's at 100, you've got $20 of real value. That's why that's called in the money. And if you have a right to sell something at 80, but it's at 100, it doesn't have value, so that's out of the money. So I always like to get people at least thinking that way. What are you really doing when you buy or sell an option? What is your right? What's your obligation? And then that'll basically help you think through whether they're in the money, at the money, or whatever. So
George, for the viewers at home, which type of option do you like? Do you like in the monies, at the monies, or out the monies?
It depends whether I'm buying or selling them. And it depends on the other factors we'll talk about, like time decay and time premium, which we're going to see in a few slides. And it depends on things like volatility, which we'll discuss throughout this whole series of tapes that you're going to see. So there's a lot of different little issues that we want to get into. But typically, when you're at the monies, you're typically selling those primarily because of the premium in many cases. But I do like the longer term options too in many cases, because I like to give myself a chance to be right. And I think most people who trade options who don't do a good job is because they're playing with the short term options and they don't give themselves a chance to be right.
Yeah, we had discussed this before, and it's that buying. One of the things that we found was a mistake in options traders was buying options with too short a time value to expiration. And the leaps and the longer term options really are the best choice economically when you look at how much time decay is affecting those options each month.
Exactly right. Well, let's on your screen there you've got what we call the intrinsic value calculations. Here we have an example, and we're going to talk about calls right now. For example, if the stock price is at 45 and you have the 30 call option, you basically have the right to buy something at 30 and sell it at 45. So therefore, you have $15 of real value. That's basically called your intrinsic value, okay? And the real value is your stock price minus the strike price of the call option that you have. So remember, it's very important. Intrinsic value is one of those issues where, let's do another quickie example. Let's say you have the 40 strike and the stock's at 50, you've got 10 points of intrinsic. If you have the 40 strike and the stock's at 60, you have $20 of intrinsic value. Okay? The other element is something called time value. Options have intrinsic and then time value. Time value is the premium minus the real value. Options, remember, you're giving yourself a time to control an asset. So the longer the time frame, the longer what's called the time value. So all you're going to have to do is take the premium minus the real value. In this example, for example, we've got the option premium is $17. Going back to the previous example, we had real value of $15. Therefore, time value is just $2 here. Right. Okay, and that time value you lose over time. So now they see a time premium decay chart. We call this. This is a very, probably one of the most important charts they're going to see. Why don't you give them a little bit of info on this?
Yeah, you don't want to be a buyer on the right-hand side of this premium chart, because if you notice, that's where the steepest curve is. And I have been known to do a little snow skiing in my day, and I can tell you what, when I started snow skiing, I wasn't skiing off the right side of this chart. I was skiing on the bunny slope, which is the long-term option premium side of this chart. And this chart is actually broken down into 4 parts, where if you notice, with 120 days to expiration, your time decay, if the stock goes nowhere, and the everything remains the same. Volatility remains the same. News, there's no real news out. Things are just kind of, the only thing moving is time. That's how time is going to be affected on the longer-term options. Now, go all the way to the right-hand side and look at the 30-day options. That's where the most time premium is going to get sucked out of the position. You know, and as we call it, the life getting sucked out of the option usually occurs in the last 30 days.
Yep.
The other thing that I want to make a point of, and that is that the last 30 days of options premium usually will count for 50% or more of a 90-day options time premium.
So really what our viewers should understand, and we're going to try to certainly highlight, that screen that has time premium, that is one of the major things they got to learn how to read.
It is.
They got to understand that better than anything, really. Let's talk about the put options. Remember, the put is the right to sell a stock at agreed to price as the buyer. Therefore, the seller will have an obligation to buy that stock at that price. So let's look at a different example. Let's assume you've got the put 50 strike price put. With the stock being at 45, you have a right to sell something. You have the right to sell the stock at 50 to somebody, but it's at 45. So you got $5 of real value. What we're talking about here again is the real value being the intrinsic value of the put option. Okay, so you calculate that by taking the strike price minus the stock price, and that will give you the calculation for, quote, intrinsic value, which you see as being real value. How do you lose intrinsic value, Tom?
Well, in this case, if the stock price goes up, and it's a good question, because what I wanted to make sure that the people at home understood was that in the case of puts, if the more the stock price drops, the more intrinsic value gets built up into your position, if and only if the actual strike is above the stock price.
Okay.
But you just asked the question, how do you lose premium? Well, in this case, if the stock price moves toward the strike price, whether it's up or down, if stock price starts moving toward the stock price, then your intrinsic value is going to shrink. Okay. And you're going to eventually have more time value in the position than you do real value.
Right, so the viewers have to understand that you can lose intrinsic value, but that's if the stock goes in the other direction of what you thought it was going to happen. Now, time value, on the other hand, on the put side, is just the premium minus the real value. Remember, whatever you're paying or selling the option for minus its intrinsic value or real value. For this example, let's take the premium being $8 and the real value or the intrinsic being $5. In that case, your time value is $3, okay? So that you're going to lose with the decay of time, correct?
That's correct.
Okay, so the intrinsic value on this, you're going to basically lose only if it's going against you. So if you're buying a put, it's if the stock price is going in which direction? Everyone out there, test yourselves, because that's what you want to do. I'm not going to ask you, Tom, because I know you know the answer to that. So what we want you guys to understand is that there's a lot of terms here. They're not that hard, so if you want to go back to review the tape as many times as you want, that's the beauty of having this kind of tape. But I want you to get comfortable with what a buyer and seller's rights and obligations are when they're buying or selling puts and calls. Okay, let's talk a little bit about what we think is the most important part of our trading. It's called the risk graph. Remember, a risk graph, I think for all the speeches we've done and all the classes we taught, we try to tell everybody the risk graph is a picture of reward and risk. And you don't want to basically put money into a trade unless you understand what the picture is, correct?
That's right. Most people have pictures of their family in their houses and stuff. You and I got pictures of risk graphs.
That's pretty sick, Tom.
I got a nice risk graph sitting over the mantelpiece. It's beautiful.
You sicko, you. I'm sure your family. Your home pictures, your wife, the dogs, the cats, the kids, with a risk graph right behind them.
That's right. There's a transparent risk graph behind it.
Okay. Anyways, let's talk about the 6 ones. Long stock, short stock. What if you buy a stock? What if you sell a stock? That has very distinct risk graph. Long call, short call, long put, short put. Remember, long call means you buy calls. Short call means you sell calls. Long put means you buy puts. Short put means you sell puts. I think I got that right.
You got that. That is, as Arthur Fonzarelli says, that you are correctamundo.
Okay. As you can see, with these tapes, we lose our mind as we go. So just stay with us. Okay.
So let's start with the long stock. That's the thing everybody has in their account. I think everybody is very familiar with buying a stock, and why don't we show them the risk graph
let me go ahead and I'm going to do my best job of drawing this thing. You have it on your screen there. Basically, when you buy a stock, you have unlimited reward, meaning that if you buy a stock at 50, I'm going to go ahead and I'll do an example here. Buy a stock at 50, it can go up to, you know, whatever, 1,000 and you make the money. However, you have the risk to the stock really going to zero. Okay, so the stock, some people say stocks don't go to zero. Well, I beg to differ there. Okay,
yeah, me too.
So, you know, you got to be careful because if you look at the risk graph, it's basically, I call it a 50-50 shot. You know, you can flip a coin and that's what you're trying to do. People then say, well, you can use fundamental analysis to try to figure out which way it's going to go, and most people are wrong anyways. Technical analysis, they're probably wrong again anyway. So this is, you can see it's a 50-50 shot, you know, when you're going to buy a stock.
Yeah, and I'm not really a big probability guy, but I have to agree with you here. I mean, it's just, you know, you're buying the stock at today's price, and, you know, no matter how good you are at technical or fundamental analysis, and we're going to teach you what we use, which works more often than it doesn't. But you know what? No matter how good something worked in the past, it's always going to be a 50-50 shot going forward. So, you know, when you look at this risk graph has what we call a Pepto-Bismol factor. Isn't that right, George?
Yeah, that's true. Yeah, the high Pepto-Bismol factor, which means lots of acid indigestion. You know,
and lots of being awake at night.
Yeah. Let me go ahead and let me create an example here. And since, you know, people out there, let me kind of show it with some numbers. Let's say I buy, you know, we'll use easy numbers. 1 IBM share at, what price should we use?
100.
100, that's a good price, okay? Okay. Here what you have is a risk graph has 2 lines. This being the price of the stock here, okay, can go up or down. This being your break-even line, that's where you make or lose money. This is how much you make or lose. Once again, remember what that risk graph looked like. In fact, better, okay, this is what it looks like. So if it goes up, you make money. If it goes down, you lose money. If you bought it at 100, that'll be the price right there. Now let's assume the stock goes up to 110. What do you make? Let's change. You make $10. In fact, this is all it is. Okay? If the stock goes down to 90, all right, you're going to lose $10. So it's really pretty much a dollar for dollar move. And that's what most people don't realize. I don't, you know, God, after all these speeches we've given, most people don't realize this is what they're doing to themselves when they buy your stock. But, you know, what people say, you know, it's un-American not to buy stock. So, you know, the bottom line we think is just we'd rather do options, which we're going to show you in just a little bit. Let's look at the short stock. Short stock means you actually borrow the stock from your broker. You actually got to get approval from them and say, I'm going to sell this stock short, which means you're trying to do the other direction. You're trying to make money if it goes down, not up, right?
That's right.
Okay, and so therefore what happens here is you're hoping it goes down. If you can see from your graphic, and we'll give you an example here, you're expecting the stock to go down. Therefore, if it goes down $10, you make $10. If it goes up, this one truly has unlimited risk.
It does. Yeah, and I think of stocks like Rambus and the stocks that were just really flying high where people thought they had topped out and then doubled again and doubled again, and you know you can only take that much pain.
Right, exactly. Well, you know, let's go back to my example I had on IBM at $100 a share. Let's assume I'm the short seller instead. What we're going to do is just go back. I'm not even going to create a new risk graph. I'm going to just show you that it's the mirror image of buying the stock. In fact, all it would be is a mirror image. Okay, so this would be selling stock short, going this way, and over here this would be buying stock. Okay. So in selling the stock short, if it goes the other direction, if the stock goes to 90, you now make $10. Okay. On the other hand, if it goes to 110, you lose the $10. Just the opposite. And I think, you know, it's easier for them to see it on one page than it is sometimes on 2 pages because it kind of shows you that everything's a mirror image.
Yeah, I agree with you.
Okay. Let's talk about options now. Long calls, buying calls. Okay. If you look at your screen, you're going to have unlimited reward to the upside and limited risk. Limited risk on buying an option or a call option first is the price of the premium. So if you buy an option for $3, the most you can lose is $3, specifically a call. However, if the stock goes straight up, you can make whatever, unlimited reward. Okay? And we'll give you an example in just a second. In fact, let me go ahead and do that before I do the short call because it's kind of very very easy thing to show you guys.
And while George is putting this on the screen here, guys, realize this, is that it doesn't take that many steps to actually create a risk graph.
Yep.
I mean, all he's doing is he's drawing a vertical line, he's drawing a horizontal line, he's got his price line, he's got his P&L line. The next step he's going to do is he's actually going to put the risk graph in,
Yep.
which in this case would be a long call. That would
Yep.
be step 3.
Okay? So let's say we buy, in fact, we're going to show you how to do some orders. Let's say I buy one IBM, okay, January call at $5. Let's use $5 as an example on IBM. We got one thing I'm missing here, which you want to put, what is the strike price? Let's go ahead and buy the IBM 100 call. All right? So what we're going to do here is you're going to do the following. The most you can lose when you buy an option is the price of an option. This is called your premium. So you can lose $5 here. You know we have unlimited potential reward. Let's put the $100, okay? Right here we've done something, okay? What's going to happen is when you create your risk curve, which you saw a little while ago, you're going to in essence start doing the following. You're going to start going to the price at which you bought your option, and then you need to shoot through up. You got to shoot it up exactly like you're going through your break-even line. Now, the interesting part, as you can see, it changes direction where you bought that option. Okay, so it's not that hard to do. We're doing it by hand, but we really use computers most of the time to figure this stuff out, and we'll spend a little time about that. And so this would be 100 here. This would be what's called your break-even point. Okay? And when you're doing a long call, it's a very simple calculation. You're just going to take your strike price here, okay? The strike price, what is it in this case? 100 plus your premium, which is 5. This would be 105, okay? So in essence, what happens is you're going to take your strike price for whatever call it is, add whatever the cost is, and that's called the break-even point. And remember that term, at expiration.
Yeah, the risk graph looks a lot different today, guys, and,
Yep.
and that, you know, that's where George and I can do our best artistic work possible, but we're not going to be as good as option software would be in determining your theoretical value.
You know, just quickly to kind of show them what we mean about that is, remember, options lose value over time. So when you first buy the option, it's not that you've lost this $5. You don't lose that till the day it expires. In fact, the option, quote, risk curve will not even look like this until the date expires. To give you my best shot at hand drawing one, you know, it may start off like this blue line and starts to shoot up. Over time, it becomes this due to time decay, okay? So remember, time decay will bring this option value down, especially if it's not moving in your direction.
That's right.
Okay, now let's take a look at what the short call option looks like. Short call means you sold the calls. Now, the worst thing is doing what's called selling a call short naked, right? Naked calls means you have a call option and you don't have anything else to protect it, unlike what's called a covered call where you own the stock. If you own stock and you sell call against it, you're going to have an obligation to deliver stock, but you basically already have the stock. Problem is people who sell naked calls and they don't have anything for protection. Bottom line is, you can see on your screens, you have unlimited risk, you have limited reward. The reward is limited to the premium that you took in by selling this option. Okay, let's go back to my notepad here, and you'll see I'm going to just do the opposite. In fact, let me find a new color. Hopefully that'll work well here. You're going to see that everything was just a mirror image. If I bought the calls, it's going to have upward sloping. Selling the calls, let's go do the opposite. It's going to be, as you saw on your screen, a mirror image, straight down. Okay?
Yeah, don't attempt to do this at home. We are professionals, and we don't even do this at home. This is not a good ride if you get on this thing and it goes the opposite direction, because you really don't know where this stock is likely to go.
I thought you were talking about my bad handwriting.
No.
Okay, so you mean by...
Well, that too.
You see naked options. Okay. Anyways, like I said, you know, a lot of times we've been doing this a long time. We'll do a lot of this on our computers, which will show us this effect of time decay. But remember, selling naked call options means you have sold, basically you have an obligation to deliver a stock at a price, and you don't care, you know, if it runs away and you don't have it, you're going to get killed. And, you know, that's the last thing we want people to do. Don't do the stupid stuff. That's why you're watching us. So, because we've already done it. We're trying to have you avoid that stuff. All right, anyways, let's go into what a long put is. Let's do that risk curve. Long put means you buy a put, okay, at a certain price, at a certain strike price. What it has is basically the reward is, we have unlimited here, but it's really to the stock going to zero, right? We like using unlimited because it's, you know, a big thing, gets your attention. Right. But it's really till the stock goes to zero. So if you buy a put with, you know, the stock at 20, you know, you buy that put option and the stock's at 10, it can go down to zero, which is where you make that profit on that screen that you see. The risk on a put option is the cost of the put option, just like the long call. When you buy a put, the risk is the cost of the put. So that's a lower risk thing to do. Okay, let's go ahead and let me show them quickly a break-even thing on that, because I think that they want to know that. So let's create a new sheet here. And we'll start off with our two really bad lines. $sign, okay? Let's say you put an order in for a put option. Let's buy one IBM 100 put, okay, at $7. Okay, let's use that as an example there. What you're telling somebody is that you want the right to sell IBM to somebody else for $100. Okay, you can pick whatever strike price you want, whatever expiration period you want. Let's assume this is a generic order. What's going to happen is, remember what the put looks like. The put, let me create, looks similar to this kind of line, which is a really bad line, but we're going to continue. So the most you can lose is $7 on this trade, because that's the cost of the option. And remember, once again, is it really $7 or is it more than that? I mean, how much money are we really putting in to do this thing? So,
well, we're really only putting in $7. So $7 is the most you can lose.
But $7 times 100 shares, because you got 100 shares you're controlling. Remember,
yeah, it would
each
cost
option,
a little more than lunch. That's
that's you know lunch at the Marriott in New York City or something,
that's
right?
True.
Okay, so remember, when you control an option, it's really 100 shares of stock. So you are paying for each one, you're paying 7, but it's 100 shares of stock. So you can lose, let's put it in human terms, $700 there, okay? And then the stock can go to zero, which, we don't think IBM will do, but on the other hand, theoretically it could do that. So once again, it's limited risk trade, and when you first put the trade on, also, it's going to look like the call option. It's not necessarily going to lose your $7 initially, just over time it decays, okay? This would be the time decay. Which, if you go back to our little graph we had going, that sloping downwards, and you use that analogy, which I like to use. It's a pitcher, a baseball pitcher throws the fastball. At some point, gravity has to take it, and the faster the gravity is going to be at the end of the pitch. So that's a very good analogy there. Okay, so that's a long put. Short put is the opposite. You're going to sell the put instead of buy the put. Remember, the put buyer has the right to sell the stock. The seller has the opposite, which is the obligation to buy the stock. Now, short puts, or if you sell these, quote, naked, which used to be a big thing amongst people, sell naked calls and naked puts. Once again, as a short call, we don't believe that's one of the smart things to do. So as you can see, if the stock goes straight down, you're going to lose a ton of money for limited reward. And that's a horrible thing to do.
Yeah, there's been so many people in recent that have traded naked puts and have gotten more. We've seen more margin calls coming out of retail brokerage firms now more than ever because of this one particular strategy. And when people put these on, they're not thinking about what could happen to the stock. They're thinking about that they're taking in a little bit of money and they're leveraging it up. And some brokers actually allow you to do 5-to-1 leverage on these puts because they only allow 20% of the stock price in. And even when you think of that, you take the 20% of the stock price and you can actually put what you received and you put on top of that, so it can become a highly leveraged instrument, which could send you to the poorhouse real quick.
Before I recap, why don't we go ahead and let's just give a little summary of what people do with calls, puts, and stocks, because they like this at their live class, so I'm going to go ahead and do it at this point. Remember, markets go up, markets go down, markets go sideways. You have 3 instruments you can basically trade. You have stocks, you have calls, you have puts. Okay? In an up market with stocks, you buy stock, which most people aren't really good at. In a down market, you're supposed to sell stock. I'll put supposed to. In a sideways market, you're supposed to stay out, which most people are really bad at. Okay? In the calls, in an up market, you buy calls. Down market, you sell calls. Sideways markets, you sell options primarily because the time decay element. Okay, in the put side, in an up market, you're going to sell puts. Down market, you're going to buy puts. Sideways markets, you're going to sell puts. Okay. Now let me just put a little asterisk where selling options are, so you guys always remember. And this is the point I try to do at the seminars. Okay, never, ever, ever, ever sell naked options. Okay? That means that no matter what you should do, if you're ever going to sell an option, make sure there's something around to cover it. For two reasons. One, the risk is tremendous. And number two, your brokers are going to require you to put more money to do that. Right?
That's right. And, you know, the other thing I'm looking at when I see the screen that George just put up is that, you know, if I were to go through here as a experienced trader now, looking at this, you know, George and I look at stocks. Well, buying them mostly are too expensive, so I'm going to cross that out.
Right.
Selling them, it's too expensive, and cross those out. We have some great strategies here. Rather than doing stocks in a sideways market, we'll cross that out. Well, we don't like doing naked calls. We don't like doing naked puts, so that kills both of these right here. So what do we have left is buying calls and buying puts. But in some instances, even doing these things are expensive. You know, when technology stocks are really going, the prices can be inflated so high that even doing these two things are possibly not good and they're outright. What we're going to do is we're going to actually, you know, this is it. We're going home. Goodbye. No, what we're going to do, guys, is we want to actually take the three of these, and now I'm going to put this in green. We're going to take the three of these, and we're actually going to combine them so that we can lower our cost, lower our risk, lower our break-even, and lower our stress, okay? Because doing, you know, and we've both, I don't know about you, George, but I've done the naked option trading, you know, and I always traded it when it was going the wrong way. It never seemed to go my way. Right. It was, I can remember the commentators on ESPN. I'm watching my stock because it's going the opposite way, and I'm thinking, and it could go all the way away from me. It went away from me, and I'm watching this thing, and I've got unlimited risk, and I'm just, you know, me and my ceiling are having a conversation because I'm laying in bed at night thinking, where's it going to go tomorrow? Where's it going to go tomorrow? Right. And it's just, you know, there's a better way, and we're going to show you these through the tapes that we've got for you.
So really, now that you ruined my beautiful screen here, we're going to combine things like for up markets, right? We can combine those with down markets and then sideways markets.
That's right.
Basically, you can do a lot of different things, which is the whole point of why people want to sit here and watch us for so many hours.
That's right.
Okay. Anyways, let's go ahead and recap where we are. Most importantly, Tom and I are going to share our many years of experience. You know, we really trade lots of options for a living. We are options traders. We're here because we really want you to learn how to do this properly. There are a lot of people out there teaching you how to do it the wrong way. We'd like to try to teach you the right way. How to trade in all types of markets. That would be great. You know, up, down, and sideways markets. Learn how to trade profitably with limited risk. You want to limit that risk, don't you?
That's right.
You know, you don't want to do anything that's crazy. The beauty of sitting here and watching us, as your learning curve, you know, just through this, you know, this video course, is going to go up at least 10 years, maybe 20 years. You know, maybe you'll never even figure any of this stuff out. So, you know, it's really a great learning experience to sit here, and hopefully we'll have a little bit of fun while we're doing this. You're going to learn about certainly the common trading terms. You know, we're going to try to give you all the terms available out there that people learn how to use, and they're using in the trading. And certainly you're going to get a lot of exercises to be able to go in there and learn how to hopefully do the number crunching. And the number crunching isn't that difficult. We don't want anybody to be scared about, you know, the numbers. Oh, I don't understand it at this point or whatever, because they can actually go in there and they can watch this videotape over and over again. As sick as that sounds, Tom, you know, they can watch us over and over again.
Well, so I also think that, you know, we've got a lot of modules set up for you guys at home. And for the folks that are looking at maybe trading the sideways market strategies, you know, you could move straight to the sideways market strategies and focus on that module and those chapters. Or if you want to trade breakout stocks, like strategies like straddles, you could go straight to the chapter on straddles and go straight to the video module on straddles. So you know, this is a series where you don't have to go from tape 1 to 2 to 3 to 4 to 5. Right. You know, you've gone through a basics of options right now, and what we suggest you do is go back through the manual, understand the basics through chapters 1 through 7. Once you get real familiar with those, then go to the strategy that fits your profile, the strategy that you like that you want to learn more about.
I think we want to stress before we close this one up that this is a complete course. I mean, they're going to get everything they need to know, just like they do when they attend our class.
That's right.
Okay. Thank you very much, and we'll see you at the next tape.